Yeah, well, I think it's a bit of a challenging circumstance because at the current level of interest rates, I like to think we're sort of in an air pocket right now, which is the current level of interest rates is enough so that when bond yields are rising, they are hitting stocks because of that discounting effect that I was describing. And so stock prices, that's why stocks and bonds are trading together in a positive with a positive correlation. And that will probably break, that positive correlation will break when you get bond yields up high enough, they start to slow the economy. Because once they start to slow the economy, then you'd expect the Fed to ease, and that's a good time to buy bonds. And so, but the problem is we're a ways away, under the current level of bond yields, the economy is doing fine. So we've got to get bond yields up higher before we get to the point that the economy has a sufficient drag so that it ends up slowing down so that the Fed ends up easing. And so that air pocket I described is sort of an asset air pocket where, at 450, bonds are too high for stocks to keep rallying, but not high enough for the economy to slow down. You really need bond yields to move into the fives probably till you get to the point where they've moved high enough to create enough of a drag on asset prices in the economy to start that easing cycle to actually kick off. And it's going to be it would be a painful period transitioning from 450, say, to 550 for traditional asset prices like stocks and bonds.
This is why it's so great having you on. I like this description of an air pocket. I want to hear a little bit more about the air pocket that we're in. And when did we kind of enter this dynamic? Was that more recently? Was that like we were saying, that wasn't like too long ago. Can you I want to hear more about this air pocket that we're in.
The air pocket.
Yeah, the air pocket. Yeah.
Yeah. Well, I think there was a reason to kick off the year. We were in a pretty unique position, which was expectations of U.S. growth were very weak. And we had just experienced the largest financial conditions easing in 40 years in the fourth quarter of 2023. So you put those two things together, that was very positive for the real economy and positive for shifting sentiment. And so what happened was people went from expecting the U.S. economy to be pretty weak in 2024 to now expecting it to be very strong. And bond yields rose consistent with that. And so you could have a circumstance where stocks outperform bonds, and that's exactly what happened, reflective of that stronger expected growth in the economy. But then eventually the bond yields, the expectations rise enough and the bond yields rise enough so that starts to flip. And that's really where the air pocket exists. It's an air pocket between sort of 450 and 550. And I think that's one of the challenges because, as you said before, don't you think people, at 5% will find bond yields attractive? And I think the real question about when do bonds become attractive, they become attractive at the point in which you think the Fed is really going to start easing. Well, so far, no signs that the Fed is really going to start easing anytime soon. There's a lot of hope that they might ease. There's a lot of speculation that they might ease, but the data doesn't align with the Fed easing at all. And that's the pain point that people keep running into, which is you keep expecting easing and then it doesn't happen, and you keep expecting easing, it doesn't happen. And you don't want to be buying bonds until you get to the point where it's pretty clear that there's a darn good reason to ease. Well, secularly low unemployment, not a good reason to ease. Inflation above target meaningfully and getting worse, not a good reason to ease. There's no good reasons to ease in the market yet. And so that's really the air pocket, is this sort of this point where there is not enough evidence for easing and where financial asset prices need that easing to reaccelerate at this point.